This is a Momentum Media production.
Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
Hi, good everyone. How you going? Phil Tarrant, host of this Smart Property Investment Show. I'm here for Property Finance Uncut with Paul Glossop, CEO, Finni Mortgages. Paul, how you going?
Well, mate, back from a very good break and a rest, but I don't think there's going to be any rest for the mortgage holders of Australia, unfortunately.
Yes, we know. Everyone had a holiday in January. Reserve Bank of Australia did not meet. They've just met today. 25 basis points hike as expected, Paul. People sort of picking themselves off the floor.
Mate, I think, unfortunately, they're probably more prepared for it now because the data and the media has been in overdrive, basically outlining what all these interest rate hikes are actually going to mean for any mortgage holders across the country. And that's now the 9th increase that we've seen in effectively 10 months. And we're now also seeing that coincide with the largest property drop from a residential standpoint, largest drop in actual real value that we've seen since the early 80s, mate.
Yeah, and we've telegraphed a lot of this. This is part of the cycle that property goes through. And if you think property always goes up in linear fashion, you're wrong. It ebbs and flows up and down, much like the share market. Paul, what are people thinking right now, having been told literally a couple of minutes ago that there's 25 basis points hike in the interest rate?
Mate, that's the big one right now because I think there's still the reality of where the data stands is that there's still probably about 1/3, if not a quarter, of all mortgage holders are still sitting in a position where they've got rates and mortgages that they fixed either a year or two or even 3 years ago at a much sharper rate. So the reality of what this is going to mean really depends on where people's decisions were 12, 24, 36 months ago. But I think as we go through this year, it's going to become more and more real for more and more people across Australia with 10 million properties and the best part of, a few 100 million different loans that are floating around out there. We're now in a position where effectively after 9 interest rate cuts, if you were fixed on around about let's say a circa 2.5% rate on $1 million total exposure, let's say a year ago, and you're now rolling into variable at around about a 5.5% to a 6% rate on that same $1 million loan, you're going to have to find around about $2,000 to $2,500 per month that you didn't otherwise have to find as of literally 10 months ago. And if you're on a fixed income, i.e. if you're a PAYG worker and you can't really affect how much money you earn or how much money you take home on a weekly or a monthly basis, this is the real stuff as far as how to actually sharpen the pencil here and get in touch with your bank or your broker, because this is where the rubber's going to meet the road for 2023.
So let me simplify that. So you're on a fixed rate product that will expire at some point in time. And they're saying over the next year, a lot of fixed rate products will come off. Your interest rate automatically resets to the variable rate. It'll be in your mortgage documents, go have a look, variable rate, and therefore you need to start paying your mortgage based on that variable rate. That's a big hit for a lot of people's back pockets.
It's enormous, mate. And, I ran the numbers there on $1 million debt. You can simply just halve that if you're on $500,000 debt. You're effectively saying that you have to find, let's say on an annualized basis, you have to find $12,000 to $15,000 a year after tax to make your payments on either your home mortgage or your investments or a combination of both. And we've talked a lot over the last 6 or 7 months about one thing that is helping investors, definitely not helping owner-occupiers, because if you don't have an investment, then this doesn't mean anything to you. But from an investment standpoint, we're actually also seeing one of the largest cycles of increase in rents across the board. And personally speaking, I literally just got off the phone before this podcast with one of my property managers up in the sunny Brisbane area. And effectively, we're looking at a raise of anywhere between 10 and 15% on a couple of different investments up there. And that is extremely important to coincide with not only your mortgages, but where you're holding your actual rents at the moment. Because if you're looking at tempering this and going back to anyone who's on a PAYG salary, you've got to think about how do you move the dial. The options are, do you ask for a pay rise? Do you get a second or a third job? But if you've got investments, rents are going up. So that should hopefully ease the burden for some of them.
Yeah, and if you haven't yet reviewed your rents over some period of time, I highly recommend you get stuck into it. The issue you have, Paul, is that if you're a property investor, you've got that mechanism for increasing the cash that you can generate from your investment. If you're an owner-occupier and you're paying down debt on the family home, not a lot of give there in terms of being able to quickly and immediately manufacture more cash to help sustain the investment. So no doubt you've got to get stuck into your mortgage and make sure you got the most appropriate one for you.
That's exactly it, mate. And I think that's where anyone who's listening to this podcast really has to now take notice and really go, I think you mentioned a second ago there, is go back through your mortgage. If you don't have essentially your hard copy mortgage documents or your online statements to understand where your mortgages are sitting, get in touch with your broker or get in touch with your bank to firstly understand what your actual mortgage rates are now if they're fixed, and also start to understand what they're going to revert to if they're going to variable, and also when. So you really need to know what that number looks like. But I think probably what you can do, that's essentially going to happen regardless of whether you know that number or not. But what you can do to actually save some of the cash along the way. And one of the big benefits of going through this cycle is banks have become far more competitive than what they were 10 years ago. So if we go back to those real raw basic numbers of $1 million in debt, if you've got going to revert to, say, circa 6%, and there are definitely going to be lenders with exactly the same products, exactly the same offset accounts, exactly the same LVR requirements, they're going to be potentially up to 0.5, 0.6% cheaper. If you're doing $1 million debt, you're talking $5,000 a year straight away by understanding what else is out there and available for you if you were to actually keep like-for-like products. So this is the key part now, is that if you, A, firstly know where you're going to end up landing at, but B, talk to your broker about understanding what can we do differently. Because the other thing that's on the table right now in spades is cashback offers to switch your loans to another lender if you're going to fit within their criteria. And they can be upwards of $2,000, $3,000, $4,000, $5,000 per loan. Yeah,
do yourself a favour. Call your banks, your current banks, and see whether or not they can shave a few basis points off your interest rate. Good luck with that, because most of them are hold firm. So the only way to get a sharper rate or a different product or a more appropriate product is to actually switch lenders. And that's called refinancing. Paul, is the team at Finni Mortgages seeing a lot of refinances lately?
Mate, we're entering into the highest level of refinancing in a decade. And it's no question or wonder why that's happening. It's quite obvious, is that we've gone through 10 years of basically no movements up in mortgage rates. Now we're going through 10 months effectively of every month, more or less, we've got an interest rate hike up. So refinancing is absolutely critical and is what we're seeing more of than anything else. And is actually where mortgage brokers, in particular our team at Finni, are able to do their best work. Because, talking to your existing bank and trying to sharpen the dial 0.1, 0.2%, it may be possible, but is that going to actually move much at all from what your outgoings are? Likely not going to be much, if anything at all.
So it sounds to me, to summarise, you've got to be proactive. You've got to get on the front foot. Even though your interest rate might be resetting in a year and a half's time, you've got to start planning for that right now. How soon before it resets should you be thinking about refinancing? Is it best to have that conversation early on so you know where you're at?
Absolutely, mate. I think there's probably two big steps here. A is the valuation on your home, and B is what products are going to become available. Because one thing we did talk about right at the start of this podcast is we're about 10, possibly 11% down nationally on where prices stand. Some markets are close to 15%. Others are a lot less, i.e. Perth, Adelaide, and potentially around about neutral. Why I'm bringing that up is that if you start the process of going through a valuation of your property or properties in your portfolio, the likelihood is that you're going to get a more of an optimal valuation now if you start the process. And why that's important is that can benefit your LVR and put you in a stronger position to actually then go out and see how you can refinance to other lenders and make yourself more attractive. So if I'm talking about timing and reverse engineering when you should be considering this, if your loans are coming off anywhere between 3 and even up to 9 months between now and then, you really should be starting to talk to your bank or broker right now, because the process should be starting to really optimize what options are available. If you can't do anything, you need to know what you have to change, potentially even your lifestyles, your subscriptions, your gym memberships, your eating out habits, all those additional things. This is super important. People planning holidays for next year, etc., school fees, whatever it looks like, you really need to be ahead of this, because this is going to be a very significant number that will impact every single mortgage holder.
Okay, so what do people do? Can they speak to your team, Paul?
Yeah, absolutely. They can get in touch with us, finny.com.au. If they jump on the website, literally they can either click and talk to someone immediately or just lock in a time to actually do a full portfolio review. Our team are at the helm ready to take those calls and take those emails, because we've staffed up accordingly, knowing that the actual refinance process is a lot more labour intensive for our team. And we know that that's where the best work we can do is actually going to be available. So our team are absolutely ready and raring. So finny.com.au if they do want to get in touch with us.
All right, go and check it out. And that's if you've got a principal place of residence or mortgage finance for investment property. These guys will look after you. It's Paul Glossop, CEO of Finni Mortgages, finny.com.au. Thanks for tuning in, everyone. Remember to check out smartpropertyinvestment.com.au podcast. We're here twice a week to keep you informed about what's going on in property and, importantly, in this cycle, interest rates. We'll see you again next time. Until then, bye-bye.